Howdy, this is Michael Good from reapertrades.com. This is your Saturday morning mailbag. Just a couple questions today. First question is, what do I mean when I say a stock is overextended? There's only a few technical analysis things that I really pay attention to. Price, volume, support, resistance. Let's look at MCGC so I can show you resistance. So resistance means a stock has gone to a certain point and failed to break above that point multiple times. So for MCGC, about $5 a share is important resistance. Today it broke above that. That was a very nice breakout. Support is just the opposite. So here on the same chart, it dropped down to about what, 380 or so, or 390 multiple times, 3 times here, and it started out down there on that gap day. And then it couldn't break below that, so it bounced up and went up. So, I mean, it's not magical, it doesn't work all the time, but especially for lower price stocks that more individual investors who believe in technical analysis trade, these things will be meaningful and will tend to work. But meaningful and tend to work does not mean it works all the time. It may work 60% of the time, and it works unless it doesn't. Resistance, it may appear that there's resistance at $5 a share, but then this, after say one day and then drops, but then it may just break right through that. So let's go to WaveX. So this one, it had a very nice breakout right around 280 here, or if you go by the intraday high at $3 a share here, but then it's kept going since then, and it's up to 380 now. So I'd call that a bit of an old breakout, and I'd say it's overextended. Why? Because it's gone away from wherever the support is. Once it breaks past that old resistance, the resistance becomes support, and the further it gets away from that without going sideways for a bit or dipping, coming back, this all builds sort of support here. Ideally, you have it like right down here where it doesn't really go very far up or down. It just sort of goes sideways for a week, 2 weeks, and then it breaks out. And then it consolidates. That's known as consolidation. And it breaks above that. So if a stock just sort of keeps going up, it's not consolidating. The breakout can be seen as being overextended. An intraday example of that, VISN today. I mean, look at it. From 10 cents, and then see, it's making a huge move, but it's consolidating here, going sideways, then it goes up again, but then it just goes vertical. So that is way overextended when it gets up here, and then it drops out off of that. So that's just how I use the term overextended, support, resistance, and you won't find me using much of any other technical analysis. Intraday, I pay attention to price and volume. So I won't bother to show that. But if you have a stock where the price action is favorable but there's not much volume, you want to wait until you see a volume spike. Anyway, that's that. Second question, what do the new SEC rules mean for short biased penny stock traders? Not much is the answer. There'll be, it's not really an uptick or upbid rule, but you basically can't hit the bid if a stock is down 10% or more in one day, and for the next day following a stock going 10% down or more. So let's take a recent example of a penny stock that's gyrated a bunch and that some of us have traded from the short side. IFLG, Infologics. So it went up from 3 to 550, gapped up, then faded. So here's the end of the day here on the 23rd. It was still up a bunch. Okay, so you can still hit the bid if you're shorting, no big deal. This day here, the 24th, it goes down 10%. Once it's down by 10%, you can't hit the bid. You have to be the best offer. You can put your offer just 1 cent above the bid, and it's not really a big deal. It won't slow you down much, but you can't hit the bid. And this next day, you can't hit the bid. But anyway, on a stock like this, it was better to short the bounces, in which case you short with the best offer, not by hitting the bid. And the ideal times to short these stocks is often on green to red on the first down day, and that's definitely before it's down 10%. So in reality, this isn't really going to make a big difference. It'll slow someone like me down occasionally on every 20th stock or something, but it's not going to harm me very much, and it won't harm my profitability. Time's up. See me next time.